Well, SVB Energy International founder and president Sarah Vakhshouri joins us now from Washington. Sarah, great to have you as always. Does this kind of give the market more confidence that at least the political fragility of this deal may be removed somewhat from the sort of array of concerns on the demand side?
Thank you for having me. Yes, of course. It has been very soothing, I would say, for the market since last agreement and the extension of the deeper cuts that the OPEC Plus have agreed in their previous meeting for another month, even though it's going to have a marginal effect, but it's still very important for the market.
So why just for 1 month, and what do we expect to come next?
This is a very good question. When we're talking to different parties and producers involved in the whole OPEC Plus countries, especially Russia, it's very important to understand from their perspective of for how long they can continue with the current deeper cuts. We should not forget that OPEC has already have a plan for continue the cuts that OPEC Plus have agreed, but to continue the current 9.7 million barrels per day of cut plus that they have agreed is not going to be easy, especially for Russian producers and service companies, to go beyond overall total like about 5 or 6 months. Also, the Russian producers have different expectations from the market. They are expecting that the demand is going to pick up from June onward. So this month is going to help to understand a better trend of the demand, how it's going to pick up, but it's not going to be very easy on Russian producers and service companies to continue sustaining the current deep cuts. So after that, even if the cuts do not agree for the month after this, still there is an agreement in place for OPEC Plus cuts, but also the joint committee of OPEC Plus is going to observe and have meetings every month, and they're looking into supply and demand market fundamentals and decide accordingly that how much the OPEC Plus should take supplies out of the market. So they're trying to balance the market on a monthly basis.
Right. Sarah, are you feeling more optimistic when it comes to the demand side as we see economies start to kind of come back online? We had the data showing that China actually imported record levels of crude in May. Is this a sort of feeling that perhaps as the lockdowns ease, you can see greater demand?
Well, this is a very good question. I think, yes, we are optimistic on a demand growth. We see more of a gradual demand growth for oil in overall sectors, but it's very important to consider and to know that different distillates and different petroleum products are going to have different growth trends. For instance, we're thinking that for gasoline, especially that we are heading into summer and a peak driving season in the United States is going to grow rapidly, even maybe higher than years before, because people feel safer to drive with their cars. They might be hesitant to use public transportation or flights for travel, so they're going to drive more, which means that there's going to be more demand for gasoline. On jet fuel and flying, we are not expecting that jet fuel is going to recover that fast. It might be more of a, let's say, L-shaped recovery, not that fast. When we are coming to diesel, well, the diesel to begin with did not have a dramatic drop the way that jet fuel and gasoline had, but the recovery for diesel and industrial use might be, again, slower than gasoline. But overall, for oil demand, yes, we are expecting for the demand to grow, unless you're going to see a second wave of COVID-19 outbreak sometimes in the fall, and if there is another tight lockdown in the U.S. and globally, then we might see another demand shock. But as of now, if there is not a second wave of outbreak, then we should see a demand growth.
Now, Sarah, alongside the OPEC Plus deal, Saudi boosted its official selling prices, pretty much erasing the discounts made during the price war earlier this year. Will other producers follow suit? And what does this mean for refiners? Surely a squeeze on those margins.
Exactly. So the refiners were expecting different heavy light spreads because of the IMO 2020 before the COVID outbreak happened. But now we are having a huge chunk of heavy crude oil out of market because of the OPEC Plus. Significantly, Saudi Arabia and Russia cut back a significant chunk of heavy oil out of the market, and now they have raised their prices. We should also consider that both countries, especially Saudi Arabia, is exporting less volumes of oil, so it's important for the kingdom to raise its prices, also prevent further price collapses. So overall, has changed the light and heavy crude spread for the refiners. Also, looking again at the gasoline and bunker or light distillate, heavy distillate margins also have changed for the refiners. So pretty much very different trend from what they were expecting before the COVID-19 outbreak.
And Sarah, let's get to the shale patch in the U.S. What does that upward trajectory for oil prices imply for that space?
This is a very good question. So we have been discussing with many different U.S. shale producers and E&P companies, both back in March when the prices dropped dramatically, and now that the prices increased beyond everyone's expectations. So what we realize is that most of the producers are not going to change their strategy that they have started taking when the prices had a downturn trend, which means that now the priority is not necessarily to maximize their production, but it's to maintaining cash and cash flow. They are having their focus only on their long-term strategy and better assets. But something that we should consider is that most of the U.S. production cuts in the past month were happening due to the shut-ins, which are a more short-cycle activity. So as we see the prices are picking up, we could see the production to recover, especially that now we're hitting the driving season in U.S., the peak demand, gasoline demand is picking up. So we might see a growth in U.S. production, but then as we're moving towards the last quarter of 2020, all those reduction in the drilling activities in most of the U.S. Shale fields that are more going to impact a longer cycle of production, they're going to kick in. So in the next couple of months, we might see a production ramp up again. But as you're getting closer to the end of the year, we might see again another cycle of U.S. production drop. This is mostly due to the long cycle activities or rigging activities drop.
Sarah, thank you so much for your outlook on the way the oil markets are faring this morning. And with that, let's check in on prices this Monday.